Okay, hopefully that's on. I know my value, given that I have a half hour, and in fact they told me only to speak for 20 minutes, so I know what I'm worth. All right, so actually I should go back to my title because I changed it from what I originally submitted to Lori and what's in the program, and you probably don't know, but I broadened it a little bit. It used to say going private decisions, now it says firms exits, and you'll see why that is. It's because I've kind of also broadened what I'm talking about to include not just my own paper but 2 others. So I'm going to do 3 papers in my 20 minutes. I'm going to start with this quote from Holmstrom and Kaplan, and you can see the date on that is 2003. So this came out of a paper they wrote called The State of U.S. Corporate Governance, What's Right and What's Wrong, or something like that. And you can see from the fact that it's 2003, it was not long after Sarbanes-Oxley was passed. And basically these are just a couple of smart guys speculating on what Sarbanes-Oxley is likely to do. And so, of course, the overall effect not clear as of 2003, probably still not clear. Our guess is that the effect will be positive for companies with poor governance practices and negative for companies with good governance practices. At the margin, this may lead some public companies to go private and deter some private companies from going public. And so, this was their speculation. What happened ultimately is an empirical question. I think this is how my presence here in some sense ties into the theme of the conference. Those of you who know me know that I know absolutely nothing about valuation, and so I'm not an obvious person to be at this conference, much less be standing up here. But I see why Peter would have thought that this fits the theme of the conference, because what I'm going to be talking about is sort of a narrow piece of this, but how the set of firms that are publicly traded has been affected by Sarbanes-Oxley. And I'm going to talk a little bit about characteristics of those firms, but mostly I'm going to focus on the set of firms. And there are a lot of ways that we can look at that. I'm going to focus on this first one here relating to firms going private, but lots of researchers have started looking at these questions, and so we can ask, do public firms go private? We could also ask, do they engage in M&A transactions so they get bought by other public firms? We could also look at, do private firms stay private? Now, this is a really hard one because of the unobservability of firms choosing not to have an IPO. So that's a particularly difficult way to try to look at the set of firms effects from SOX, but that's certainly a question we'd like to know. Listing elsewhere. This one's a little bit easier, although still, I don't think we can quite nail it. Luigi Zingales has a paper that looks at the U.S. share of the global IPO market. I think it was referred to in an earlier presentation today. What he finds is that it's dropped quite a bit from 2000 to 2005, and so he explores a bunch of different explanations for why that might have been, and ultimately he concludes that it's probably a combination of other markets getting better and U.S. compliance costs. There's supposed to be another bullet point there. So, no, there isn't. Do firms remain publicly traded? Scare me. Oh, no, that would have been my fault. I have this kind of clever way of making my notes appear, and I thought maybe I had made this thing disappear with my notes. Okay, so do firms remain publicly traded, but do so in ways that evade SOX? So this is another way that we can ask these questions, and I'll be talking a little bit about this first point here, moving to or staying on the pink sheets. So the Lloyd et al. Paper that I'm going to discuss shortly talks about firms that choose to move to the pink sheets and stop filing forms with the SEC. Canceling or never beginning cross-listings in the U.S. Last year's JAR conference, there was a paper about firms that stopped that deregistered their ADRs in response to Sarbanes-Oxley. Several people in the audience have papers that relate to this. Suraj, Joe, I think Craig have things that relate to cross-listings in the US or listings in the US compared to other markets. This last one is a little bit of a different animal, staying small in order to avoid compliance. This is one that was at this year's JAR conference where the authors looked at whether firms were deliberately remaining small to avoid having to comply with SOX. And this is something that presumably won't persist forever, but they find that firms seem to be trying to stay small, at least to avoid these costs in the meantime. Okay, now one thing I want to focus on in my talk today is that there are a lot of difficulties in doing research in this area. And the two biggies, I think, relate to control groups and the fact that there are a lot of ways to get around Sarbanes-Oxley. The control groups thing, I think, is the primary issue. We'd like to find a control group when we're asking these kinds of questions, because there's a lot of stuff that's gone on in capital markets recently. For example, the rise in private equity. It also seems like the organizational form private has gained in popularity. And so if there's just a general trend towards going private, we don't want to attribute that to Sarbanes-Oxley instead of what it's really due to. And so ideally, we'd have some kind of a control group that wasn't affected by Sarbanes-Oxley that allows us to test this. The difficulty, of course, is that any control group that we have is necessarily going to be quite different. We know that if a firm isn't affected by Sarbanes-Oxley, it's fundamentally different from the firms that are affected. Maybe it's because it's foreign. Maybe it's because it's small and only trades on the pink sheets. But we know that these are a different set of firms for one reason or another, and that's why they're not affected by Sarbanes-Oxley. So the control group thing, I think, is quite a big deal, and we'll talk about that as I go through this. And the other one here is many ways to avoid SOX compliance. As I talk here, I'll talk about going private, and I'll talk about going dark as two possibilities. I mentioned earlier mergers and acquisitions. So by focusing on one response, we may miss the effects of others. Having said that, there's only so much you can do in one paper, and so that's not to say that we shouldn't at least look at these particular paths firms take. Okay, so I mentioned I was going to talk about three papers, and the first one is my own paper with Ellen Engel and Sue Wang. The second one I'll talk about is Christian Leutz's paper with Triantis and Wang. That's a different Wang. And then the last one is one that you're probably less familiar with. Two of these authors are law school professors. I know that at least Eric Talley, the third one, also has a PhD in economics, and although this is completely irrelevant, it's a little bit curious. He lived across the street from me as I grew up in small town New Mexico. So at any rate, I'm going to talk about these three papers, and you'll see that they take different approaches to kind of addressing the same fundamental set of questions. Okay, so the first one that I'll talk about is my own, and the primary reason I'll talk about it first is because it was the first one that was, I'm not sure if it was written first, but it was published first, and I think that the other two papers they build on what we did there and provide some improvements in certain directions. So we looked at 470 going private transactions between 1998 and May of 2005. Now, we defined our sample on the basis of Schedule 13E3 filings. So this was the SEC's definition of going private, and that is that when the firm reduces its shareholders to below 300 and is no longer required to file reports with the SEC. So that was our definition of going private. And these transactions are a very specific kind of transaction because firms file this Schedule 13E3, which describes the transaction, also talks about other options that the firm might have considered, talks about whether the directors, particularly the independent directors, were in favor of it, and basically gives a lot of information. And as we'll see, it seems like this is quite valuable for shareholders. Getting this information and having firms go through the process of figuring out, describing what they've done as part of this transaction. So that's how we defined our sample. And we do a number of things in the paper, but really what I want to focus on are just these two parts of it, where we compare the pre and post SOX rate of these transactions, and we look at the firm level characteristics that predict the market response to these announcements. So as far as results go, we find an increase in the Schedule 13E3 filings after Sarbanes-Oxley. And you know, as far as numbers, we have 159 in the 33 months before, 243 in roughly the same period afterwards. We can do this graphically. So this is not quite the same numbers that I have up here. These are the by quarter numbers. So you know, you can see there's this kind of increase here. We put SOX in 2002, and then if you want to look at the pre and post means, we have, I think, 12.4 is the per quarter mean beforehand, and 22.2 is the per quarter mean afterwards, and those are different, statistically different from each other. And so when you look at that, you know, it looks like we've seen an increase in going private transactions since Sarbanes-Oxley. So that's our first result. Our second result is that we also saw changes in how the firm characteristics predicted the market response. And in particular, what we found, and this is a little bit difficult to say so that people can understand it, so I'm going to put up a table on the next page. Smaller firms with greater inside ownership see higher going private announcement returns in the post-SOX period compared to the pre-SOX period. Okay, so as I said, I'm going to put up a little picture here. Now, we ran a regression, and this is the result of a triple interaction. And so rather than putting up the regression and explaining the triple interaction, I'm just going to do this little 2x2 here. So this is the percentage point effect on the abnormal returns from a 10 percentage point increase in manager and director ownership. Right? So we increase insider ownership by 10 percentage points. What does that do to the abnormal return from the going private announcement? Okay, so large firms are here in this example the 75th percentile, small firms are the 25th percentile. So for large firms before SOX, if there was a 10 percentage point increase in insider ownership, the abnormal return was higher by 0.6 percentage points, and afterwards lower by 0.9. For small firms, we see a rather big difference. Before Sarbanes-Oxley, there was a 1.8 percentage point decrease, or lower by 1.8 percentage points, and afterwards higher by 1.2. Okay, so what we're seeing is that it looks like small firms that had concentrated ownership, specifically the insiders, had a more positive response to going private. Now, our interpretation of this in the paper, and you know, we can certainly come up with alternatives, is that this is consistent with what Holmstrom and Kaplan were speculating. We're saying is that small firms, this is greeted more positively for small firms, and in particular those that have high insider ownership. If you think that high inside ownership means interests of shareholders and managers are aligned, then this indicates potentially good governance. Now, I recognize governance is notoriously difficult to measure, so there are a lot of other ways you can interpret this, but I think there is definitely scope for interpreting this as being consistent with Holmstrom and Kaplan's speculation. Firms with good governance that are small have a more positive response to going private. Okay, now, strengths and weaknesses, all right, and you can decide which you think are strengths and which you think are weaknesses. So first of all, our sample selection was similar to the earlier literature on going private. We used these 13E3 filings as the way we defined our sample, so our results are comparable to some of the earlier going private literature. The second one, hard to identify a control group of firms that was not affected by Sarbanes-Oxley. So if we go back and we look at this picture here, if instead of drawing these two lines that look quite different, if I had drawn a trend line, then, you know, what would your conclusion be? Your conclusion might be, gee, it looks like firms are going private more, and it happens to be the case that this happened around Sarbanes-Oxley. So, you know, having a group of control firms that weren't affected by Sarbanes-Oxley would be particularly helpful here, because then we could determine, was it a single event, or was this just that more firms are leaving the public capital markets because there's more private equity out there, or whatever. All right, we can't conclude that, I think, from our study. And the last point here, most sample firms cease trading, but they can avoid Sarbanes-Oxley by deregistering. Okay, now this is going to lead me into the Leutz et al. Paper. We have some firms in our sample in this group here that filed a 13E3 but continued to trade on the pink sheets afterwards. Now, our multivariate results aren't affected by this, so we still come to the same conclusions for everything else. But when we look at this difference between the pre and post SOX mean, that's driven by these firms, which we call going dark firms, because they stop filing, but they continue to trade. And that suggests that it's probably worth taking a look at these going dark firms to see if there's something going on there. And so that's exactly what Christian and his co-authors did in their paper, and this came out the following year in the JA conference. So they've got 484 going dark firms, and they're sort of roughly the same time period as we have. And the way that they define their sample is firms that deregistered but continued to trade. Okay, so you can deregister once you get below 300 shareholders of record, and so that's what their firms did. Some of them had to get their number of shareholders below 300, but a lot of them were already there and just chose to file the papers and say, all right, we're done. Okay, so they also compare the pre and post SOX rates of their transactions, and they look at what firm level characteristics predict the going dark decision and also the abnormal the market response to that decision, and whether those have changed since Sarbanes-Oxley. Okay, so what do they find? Well, they find an increase in the monthly frequency of deregistrations after Sarbanes-Oxley. I don't have the monthly numbers, so these are just annual. We draw the SOX line in, and it's pretty dramatic. Like this one, you're going to have a harder time drawing your trend line here, although you could still try, and I'll talk again about the lack of a control sample. But it's a pretty big increase, and it sure looks like there's been an increase in deregistrations since Sarbanes-Oxley happened. Okay, what else do they find? Well, they find a negative market reaction to going dark. I think I didn't mention when I talked about going private, we find a positive reaction to that. So they find a negative reaction, and when they look at firms' propensity to go dark, the firms that tend to go dark are ones that are in financial distress or have poor growth prospects, and they measure this in a number of ways. But for example, asset growth, if you have low asset growth, that tends to predict going dark. So this means potentially that what we're getting from these firms that are going dark is we're getting a piece of information that says these guys may not need capital in the future, and so not surprisingly the market reacts negatively to this. They also find some evidence that agency costs explain going dark, and so they, without explaining in much detail, because I don't really understand it, they calculate a measure of free cash flow problems, and they find that those free cash flow problems predict going dark, and in particular that variable is more important after Sarbanes-Oxley. Okay. They also find that some of their distress variables or their low growth prospect variables change before and after. So bankruptcy is more important before, but asset growth is more important after. So there's not, I think it's very clear that there are more transactions afterwards. There's some evidence that there were agency costs attributable to the post-SOX transactions. And then as far as distress goes, there's a little bit of evidence for both pre- and post-SOX being influenced by that. Okay. Now, as I mentioned, when we look at this picture, it is pretty stark. I mean, we see a fairly big jump here, but again, we don't know for sure that this is due to Sarbanes-Oxley. That means 5 minutes.
Time for.
I thought you were telling me to stop.
No.
Don't come any closer. So the authors of this paper do a lot to try to rule out alternative explanations. They put in market performance over the past year. They put in time trends in case to measure whether it's gotten easier to go dark over time. So they really try to rule out that this is just a trend here. But we don't know for sure that firms just started going dark and continue to go dark more after Sarbanes-Oxley. So this leads me to the last paper I'm going to talk about, and this is the KKT paper. And the motivation that they provide in their paper is that we need a control group. And they give a couple of examples of factors that that might lead more firms to go private or go dark. So for example, if stock prices are depressed, we might expect to see more of these transactions. If there's more capital available, we also might expect to see more of these transactions. That's probably more relevant for going private than for going dark transactions. And so what they do is they take a very different approach to addressing this question. So they look at all acquisitions between 2000 and 2004 involving targets traded on public exchanges. So they look at both American and foreign targets, and so their starting sample is just any publicly traded firm that's getting acquired. All right? They're doing a difference in difference design where they compare, and I'm going to probably have to read this a couple of times because it takes, at least for me, a little while to soak in exactly what they're doing. The post-SOX change in the probability of American public firms that are undergoing acquisitions being acquired by a private firm. Okay, so remember, they're looking at the set of firms undergoing acquisitions, and they want to know, how does the probability that if you're one of these firms undergoing an acquisition, how does the probability that you're being acquired by a private firm rather than a public firm change before and after SOX? Okay? And so they're looking at that and they're comparing it to the corresponding change in probability for foreign firms. All right? So this is their difference in deference methodology. And they also at the same time are able to control for the level of stock prices in a listing country. So I'm going to talk fast because I want to get through this. The advantages and disadvantages of their research design. First of all, they compare the US to other countries which presumably are less affected, have less direct effects from Sarbanes-Oxley. Now, this is a nice idea, but of course it depends, how successful you are depends on whether we think that these probabilities would have tracked each other in, the changes in probability would have tracked each other in the absence of Sarbanes-Oxley. And so, you know, it's nice to have a control group, but we have to believe that it has the right characteristics. The other thing that they do here is they contrast the going private transactions with acquisitions by public acquirers. All right, so their definition of going private is you get bought by a private company. And so, again, this has a nice aspect to it because it provides a control for firms' willingness to do acquisitions. So the availability of capital. If there's more capital out there, both public firms and private firms presumably are doing more acquisitions. So it allows us to get it at that control as well. Now, some disadvantages. Well, we don't get the going dark firms. That's not necessarily such a big deal because we can look at those separately, but it does mean that, you know, maybe we don't find anything with this methodology. It could be that the reason we don't find anything is because all the action is in going dark firms, but that doesn't mean there's no effect from Sarbanes-Oxley. It just means there's no effect here. So we don't get everybody when we look at this. It also turns out that the way they've defined this, their going private transactions, doesn't even capture all going private transactions. So for example, self-tenders aren't included here. So maybe all the actions in self-tenders and going private, but even so, you know, we're at least getting some comparisons here. And then the other thing about this research design is that it doesn't get at firm-specific factors. So in both of the other two papers, we looked at a lot of different firm-specific factors like, you know, the Lloyd's paper, financial distress, asset growth, that sort of thing. So these guys don't pick up any of that stuff in their paper, which simply means that we're not going to be able to come to much in the way of conclusions about whether these are good firms or bad firms that are going private. But again, you know, it doesn't necessarily have to do that. It just means we can't draw those conclusions here. Okay, so what do they find? Well, when they look at American firms overall, they don't find any relative increase in the post-SOX rate of acquisition by private acquirers. And again, that's their language, or that's their methodology for going private. Acquisition by private acquirers is going private. No relative increase in that. But when they focus on small American firms, they do find a relative increase. And when they further explore this, they find that this increase is concentrated in the first year after Sarbanes-Oxley. So we get more American firms going private, but only the small ones, and that effect is pretty much the first year after Sarbanes-Oxley. Okay, so this is their table 1, so it's not their multivariate analysis, but you can kind of get an idea, if I explain to you what it is, what's going on here. So what they've done here is this is just describing their sample. And so, for example, percent small targets, US pre-stocks. This tells us that of the firms that were acquired in the US before Sarbanes-Oxley, 22% of them were small. And they define small as bottom quartile of their market, where they're traded. So when they do their difference in difference, the numbers that they're looking at are, in the US, the percentage of private acquirers among small targets. So of the small targets that are being acquired, 40% of them are acquired by private firms before Sarbanes-Oxley. Afterwards, that number of the small firms that are being acquired, they're now being acquired, 54% of them are by private firms. So the going private rate has gone sort of, this is loosely saying this, from 40 to 54%. When we look at the foreign firms, it's gone from 45 to 46. So that's the difference in difference that they're doing, and this is what they're picking up, is that the rate of small firms being acquired by private acquirers going private has jumped quite a bit for US compared to what happened in the rest of the world. Okay, so some conclusions. And so broadly speaking, I think the evidence does support Holmstrom and Kaplan's conjectures. All 3 studies seem to find that small firms were exiting the capital markets. My paper with Ellen and Sue finds what we interpret as evidence that, that firms with good governance were greeted, that the news that they were going private was viewed as a positive thing. Methodological problems remain. Do I think we've solved that we've answered this with certainty? No, we still have this control group issue. I think that the KKT paper does a nice job in coming up with the control group, but I think there are still reasons we can question whether we have the perfect control group, and we certainly never will. And then finally, can we say whether Sarbanes-Oxley is good or bad from this evidence? You know, of course, what I'm going to say here is that we can't answer this question. I think what we can say from this evidence is that it looks like some firms were leaving. It looks like in the case of going dark firms, it may have been firms that there were potentially some agency problems. In the case of going private firms, they may have been good firms. But even if it turns out that all the firms that left are good firms, does that mean Sarbanes-Oxley's bad? No, we have to weigh that against, of course, any beneficial effects for the firms that stay. Okay, so I only went over by 8 minutes.
Do we have a question or two?
Jeff? Oh, sorry. I'm not allowed to do that.
I was just wondering, I thought you mentioned that, I don't know if there's some papers, but are firms managing their market capitalization to get out of doing like the 404, not be an accelerated filer?
Yeah, that's the paper from, that's Gao, Wu, and Zimmerman paper that was in this year's JAR conference. And
what do they find?
And what they find is that it looks like firms are trying to stay below that $75 million threshold to keep from having to comply with SOX. And they further look at specific actions that they take, both to lower the stock price and get rid of the shares.
Hi, Rich. I was just thinking here, it's weird to give a suggestion about a paper that none of the authors are in here.
Yeah, you know, I was thinking about that too.
Yeah, but anyway, like one thing that I was thinking here is that your paper and the paper of Christian it's voluntary decision. So you choose to go dark or you choose to go private. And in this last paper, it's you're a target here. Do they show any evidence that they are more like, say, it's less likely to be a hostile takeover, or they are willing to sell for a lower premium or something like that? You
know, they don't provide any information about any of that. There's no discussion about whether these are hostile takeovers or not. And I suspect there's a mix, but mostly they're not hostile.
Because that would be very, like, say, similar to, like, I mean, your paper, Christian, suggests the firms are willing to do this and they're willing to select.
Yeah, although I think even in our sample, it's not obvious that some of those weren't hostile, because we have transactions where a private firm buys another firm, and so some of those could have been hostile as well. And they get classified as going private because the firm that ultimately ends up owning them is private, but we don't know for sure that those weren't hostile in our sample as well.